Hello, my friends. This is Brad Brain. So I saw something on social media. There was an insurance agent. He put out a message, and I wanted to disagree with it. So here's the thing. Now, this guy, he works for one of those multi-level marketing firms. So what he said was that he would only recommend term insurance for his clients. Permanent insurance, there's just no place for it in his world. And to be fair to the guy, maybe he should only recommend term insurance for his clients because, okay, sure, it's a generalization. This is a stereotype. But typically, the people that work for multi-level marketing firms, they're working with people who are, they're just getting going. They're just starting out. And for that demographic, absolutely term insurance is expected to be the better fit, right? If you're looking for something to cover your mortgage or if you have young kids, term insurance is the place to be. But that's not all of the reasons why we would buy insurance. Here's the thing. If you are successful, there's a cost that will accompany that success. And the price of success is taxes. So if you are like me, you don't want to work for your life and then have a big chunk of your fortune lost to taxes when you pass away. So there's different things that we can do to plan ahead. And so back to this idea about term insurance. Term insurance, without question, is great for young people starting out. It is a lousy tool for estate planning. Young people buy term insurance. Wealthy people buy permanent insurance. Right? They're designed for different things. And so if you want to hang on to more of your wealth, there's different things you can do. And not everybody wants to hang on to all their wealth. There are some people that are perfectly happy just living their lives. And if they pass away and a big chunk of the money goes to taxes instead of to their family or to charities, they're okay with that. And there's nothing wrong with that. If you want to lose a lot of your money to taxation, then you're welcome to do that. But for the people that want to plan ahead, there's really only 4 things that you can do. One of the things you can do is you can start saving now, but that assumes you live long enough to accumulate enough money to pay the tax bill. Second option, potentially your estate can borrow to pay the tax bill. But that's assuming that somebody's going to give them a loan in the first place if you're not around anymore. And obviously there's going to be interest costs involved with borrowing money to pay the tax bill. The third thing you could do is sell assets. And if it's just money assets like a RIF, then, there's no real attachment to a dollar amount per se. Not like there can be an attachment to a physical asset like a piece of property, right? So selling a mutual fund to pay the tax bill, there's less heartstrings that are tugged. A little bit different if you got to sell the vacation property that you want to keep in the family. So far we've got save, borrow, sell. And there's costs with all of that stuff. But there's a fourth way. And often this is the best way. And that is to use an insurance strategy to pay your future tax bill. Now, what's on the screen right now, this is exactly what I'm doing right now. I'm filling out this application right now for myself. And the reason for it is I own term insurance too. I bought a term 20 insurance when my kids are little. My kids aren't so little anymore. Now, the problem is that when this policy goes to renew, and I think I probably got about 4 years before, so I'm thinking ahead, right? I got about 4 years before renewal. When it renews, it's going to renew at substantially higher rates. And I don't want to pay the prices that will take me from my mid-50s to my mid-70s for another term policy. I was really happy paying it from my 30s to my 50s. That premium's not too bad. The premium from my 50s to my 70s, that's a different story. So I'm looking at writing a brand new, now there's nuances. In my case, I'm looking for a participating whole life insurance policy. I'm going to set it up in a specific way. There's other ways to set it up. If you're curious, I'll tell you. I'm going to do a 20 pay with paid up additions, and I'm using an accelerated deposit option. So that works for me. There's other variations, and that's fine too. And then here's the scoop, okay? Here and by the way, right now the dividend on this policy is about 6. I think it's like 6.05%. I'm not buying it just for the dividend, but when you think about what are the options for money. There are options that have guarantees, but usually they don't pay very much. This product has guarantees with a 6% dividend, so I'm okay with that. Now, there might be some people that might quibble with my language on that, and that's fair. I'm not saying that this is the same as, a stock that's paying a dividend. The permanent insurance policies, the dividend's a little different, but let's not get bogged down on that for the purposes of this video. So here's the scoop. I'm electing to pay $2,000 a month. I could get away with paying $1,840, but I'm going to put in a little extra just to top it up because I like round numbers. Okay, so I'm paying $2,000 a month. So now, in my mind, the worst thing that happens is I die. Right? I don't want to die. So in my mind, I die. That's the worst case scenario. But, I can't change that. Sooner or later, it's going to happen to everybody. So let's purely think about this from a math point of view. From a math point of view, the worst case scenario is I live a long, healthy life. And I put in $2,000 a month and I do it for 20 years. So that's $24,000 a year for 20 years. That's $480,000. Okay. Now, the best case scenario from a math point of view is I make 1 month's premium and I die. Because now I'm going to put $2,000 in and I'm going to take $500,000 out. Okay, so we scroll down to the math on this, the projections. Now, there's different things here, like what's guaranteed, what's not guaranteed. This is if nothing changes. These boxes over here, these columns over here, this is what things are going to look like. Okay, so let's, for purpose of this, we'll work with that. If you're looking at doing this with your own money, then obviously a more complete discussion would be prudent. But I'm not trying to get you to buy this product. This is the product that I'm buying, and I already know the alternative scenario, so I'm okay with that. So current dividend scale, if nothing changes, I put in, let's say, 1 month's premium, and I'm going to get $500,000 out, right? Now, worst case scenario would be right here, is I put in $24,000 for 20 years, total of $480,000, and the death benefit on that is $881,000. That's a decent rate of return. If you take $480,000 and exchange it for $881,000, tax-free and free of probate, there's nothing wrong with that. But here's the thing. The way that this product's set up, it doesn't stop growing in year 20. Now, my premiums stop in year 20, but the product keeps growing. So here, in this illustration, it goes to age 85. It's gone from $800,000 to $1.2 million after I stopped putting money in. So I get it that term insurance has a role, and when that is appropriate, I'm not going to try to tell you not to. As a matter of fact, if what you're looking to do is try to cover your mortgage and somebody's suggesting whole life to you, then that might not be the best fit. It probably isn't, unless it's like a base whole life with a term rider. Those are cool ways to set things up. But yeah, if you are looking for temporary coverage, then term insurance is the place to be. But not all insurance needs are temporary. And if you're looking to do some real estate planning, that's when you're going to want to actually look at permanent products. Term insurance won't be a good fit for that situation. I hope this will make some sense to you. If it doesn't, let me know, because I'll answer those questions. I'm Brad Brain. I'm here to help. Stay healthy. Be well. Take care.